No company in the history of the United States has ever paid taxes, and I'm going to show you exactly how that works. Welcome to the AlterNate Vantage. My name is Nate, and this is where I talk about a different perspective on financial literacy, finance news, and wealth strategies. If you like this kind of content, don't forget to like and subscribe. All right, back to the video. Understanding how companies don't pay taxes will actually impact how you pretty much make every decision in the future. Who you vote for, who you buy from, consumer price movements, the way the markets adjust, inflation. All of this ties back to this concept. And to prove it to you, let me quickly explain how the US tax system works. Now, for personal taxes, you're only taxed on what you earn as income. And in the US, it is based on a progressive graduated tax, which essentially means the more you earn, the more you're taxed. This can be 10% of your taxable income on the low side or 37% of your taxable income on the high side, which is kind of insane. Now, if you wanted to reduce your taxable income, you could buy certain strategic things that might give you a tax break or, qualify for specific deductions. But generally speaking, whatever your taxable bracket is determined to be, minus deductions is going to be your overall taxable income. So things like general expenses, like groceries or energy costs or housing upkeep are typically things that for personal income reasons, you can't qualify for those things to be deducted from your taxable income. But for companies, it's the exact opposite. And this is the first secret in realizing that the only tax-paying entity in the entire United States is you, not companies. Here we go. Okay, let me demonstrate how taxes work for companies. Instead of paying a graduated tax system where the more they earn, which is considered revenue, then the more they're taxed, instead of being like that, it was adjusted in 2017 where it's a 21% flat tax on their profits. So it doesn't matter if their profit was $1 million or $100,000, their flat tax is 21%. Generally speaking, a company's profit is determined by taking their overall gross revenues and deducting their overall gross expenses, and that number left over is their profit. So here's a quick example for you. Let's say you had a company, small company, they only earned $200 in revenue that year. Let's just say their overall operating expenses was $100. So you take $200, subtract $100, and you're left with $100. That's their profit. So they took the revenue minus their expenses, which created their profit. So in this case, the number comes out to 100. So then taxes tell us they have to owe 21% on that $100. So in this case, the taxable amount would be $21 is how much they pay in taxes. And the amount left over, the $79, would go to the business owner as take-home cash. And in the case there was no profit at all, then there's no taxes. And obviously, certain exceptions apply, but generally speaking, this is kind of how the system works. I'm not going to get too complicated here. But this is where we need to ask ourselves a very important question, which is, where did the company get the $200 to begin with? The $200 that became the revenue of $200, which is the gross profit of $100, which was the taxable requirements of $21, and they left with $79. Where did they get the $200 that kind of decided everything else that came after? And it's at this point here that we can connect a few different pieces, what I like to call following the money, to figure out what's actually happening here. So let me break this down with an example. Let's say we had a consumer and the consumer wanted to buy a product from this company we've been talking about. What that consumer is going to do, all right, is they're going to take from their personal income, which is already being taxed, and transfer it to the company, which then when the company takes possession of that money, it's considered revenue. So it went from personal income, and then once the consumer bought something from a company, it became revenue for the business. So then let's put it back into the perspective of the $200. Let's just say we had this one consumer, we had this one company, they sold one good for the entire year, and it was a $200 good item. So the consumer, they brought to the table $200, and the company said, hey, we have this $200 product, you should buy it. The consumer said, yeah, sure, sounds great. So the consumer bought the product, the company got the $200. That was the exchange. And as we know already, that company is going to walk away from that at the end of the year with $79 cash in hand, after they take out expenses and after they take out taxes. So in simple terms, we can say, well, the company got all their money they earned from the consumer. So they took post-tax dollars, generally speaking, from the consumer, gave it to the company, which then became pre-tax dollars. And then at the end of the year, those pre-tax dollars were then taxed into $79, which are now then post-tax dollars. So in a way, kind of getting taxed twice. But what I'm trying to really drive home here is that the company's revenue was generated from the consumer buying a product. So herein lies the issue. Let's say at the end of the year, that company that walked away with $79 after taxes, after expenses, and everything else, walked away with $79, they said, ooh, this $79 is actually not enough. I need more money so I can qualify for a loan, or so I can expand the business, so I can do A, so I can do B. They said, okay, 79 is enough. I actually need $100 of take-home cash after taxes, after expenses, so that I can, expand my business. So what's going to happen is the next year, that company is going to look at it and say, okay, well, I know that I need to walk away with $100 cash in hand, taxes and everything and expenses already accounted for. So what they're going to do is going to go through a process of optimizing the back end by paying for it on the front end. So all they're going to do is say, okay, if I walked away with $79 at a price point of $200, then I just need to increase my prices so that way at the end of the year, I can have a higher profit. So in this case, the company is going to say, okay, hey, instead of selling my good for $200, I'm going to sell it for $227, which is a 14% increase. So you're probably wondering why $227? If they previously were only charged $21 in taxes, why are prices shooting up $27? Well, let me show you. So once again, we have a consumer, and now they see on the shelf the product costs $227. They said, you know what, last year it was so good, I got to have it again, even though prices went up 14%. And so they buy the good for $227. Now that same company, they have the same operating expenses for the most part. That's our assumption. So we're going to take 227, subtract 100, which is the operating expenses we're using right now, which leaves them with a remainder of 127. Now that's their profit. And we already know that their profit is taxed at a rate of 21%. So what's going to happen now is that 127 is going to be deducted by 21%, which is going to bring them just about at $100. So now the business is happy because they walked away with their $100. They can expand their operations. They can qualify for that loan, whatever the case may be. But let's add to the scenario a little bit so I can really drive home where you are losing a majority of your money. So working with the same company here that's charging $227 for their goods because they desire to make $100 in net profit, what happens if the tax rate increases? Let's just say it started at 21% and it jumps all the way up to 30%. So what that company is going to do is say, okay, hey, if I'm going to lose more of my money at the end of the year to taxes, then I need to increase my prices again. So instead of selling their goods for $227, now they have to sell it for $247, which is a price increase of 24%. And here's why it shakes out like that. Using the same format as before, we know this company's revenue is now going to be $247. We know their expenses are $100, which leaves them with a net of $147. Then we have to deduct their 30% in taxes, which leaves them to their desired end profit, which was the $100. When you tie these things together, you have to ask yourself, who's winning and who's losing? Now, the company, assuming that they don't lose their customers from the price increase, they lose nothing. They're net even, they're net neutral. They desire to have $100 at the end of the year in profit, and they achieved that whether or not it was 21% in taxes or 30% in taxes. The government, however, who is increasing the taxes, they're raking in more money, so they're definitely making money on that exchange. But the consumer is paying for it on both ends. So not only are the consumers paying for their personal taxes, they are also essentially financing the tax increases that the businesses are experiencing by having to pay for it in the price that they're getting. So here's the important thing to realize when it comes to corporate taxes is that whether or not they go up or down, prices are going to change relative to that. And at the end of the day, nothing's really going to change for that company in terms of their end profit that they get to keep. So the moral of the story is this: for a company, taxes are nothing more than an expense. And when you put things into those terms, when it comes to different headlines you see in the news, the picture becomes far more clear about how it directly impacts you, the consumer. Because every single time taxes increase for a business, in most cases, they're always going to pass that charge onto the consumer because that's what they're forced to do. They don't make any more money unless we consume. And if we are consuming, then they're taxed on that based on how much we are consuming. So the more we consume, the more revenue, the more profit, the more taxes. And if they need a higher profit margin at the end of the year, they're going to pass that cost onto the consumer every single time. And with that in mind, you're going to realize now that every single large tax decision as it relates to companies really does impact you, the consumer. And this should create a good viewpoint or a good foundation on how you should view any sort of corporate tax adjustment changes, because that's ultimately who it's impacting is you. The simple thing to do or easy thing to do is to point our finger at the greedy corporations and say, hey, you're taking more of our money. But the thing that we need to realize at the end of the day is that those corporations and companies would have no money unless we gave it to them. So if you're part of the group that's saying companies should pay their fair share in taxes, then all you're really saying is, I wish for companies to charge me more money for the goods I'm already buying. And this is what I mean when I say there's only one tax-paying entity in the entire United States, and it's you. If you like content like this, go ahead and hit the like and subscribe button, because in my next video, I will be going into real-world examples where I break down how an increase in taxes or tariffs or anything else that's being charged to the company is ultimately going to come back to you.